Now, if we look at the biggie, first look at second quarter GDP, minus 32.9, minus 32.9. That, of course, is quarter over quarter annualized, and it is not as bad as the minus 34.5-ish to minus 35% we were looking for. And if we look at consumption, wow, the consumption, of course, was routed. That's minus 34.6. If we look at the price index, a whiff of deflation, minus 1.8. And if we look at personal consumption expenditure quarter over quarter, it's minus 1.1. Now, just to put a face on this, the first quarter of 1958 was our record, the only time we were double digit in the history going back quarter over quarter in the U.S. GDP, which the first quarter of 1958, the year Chevy introduced the Impala, the only double-digit drop until today. And, of course, this is a factor of 3+ more than that. What's interesting, we look at Germany today, and Germany, of course, was down 10.1%. Their previous record was down 4.7, which was in 2009. In that particular quarter, the U.S. was only down 4.4. So we see that it seems as though, at least for the moment, that parts of Europe, particularly Germany and their manufacturing juggernaut, might be weathering some of the coronavirus's effects better than the U.S., and that is a big deal. All maturities treasuries outside of 30-year bonds could be challenging their all-time ever low-yield closes. We've seen 3s, 5s, and 7s. Yesterday, it was 2-year notes. And today, right now at 55 basis points, gang, we're only 1 basis point away from that 0.54, a little more than half of 1%, which was the all-time low-yield close on March 9th of this year. Andrew, back to you.
Wow. Wow, wow, wow. Rick, stay exactly where you are because we want to have you be part of this all over again, but want to bring in CNBC senior markets commentator Mike Santoli, also senior economics reporter Steve Leisman. Steve, we're going to go to you first for your reaction.
So the big decline was in consumption, 34.6, and that translated into a real sort of tale of two worlds, just down 11 on the goods purchases, but down 43% on services. And you can see that's where the U.S. economy took a hit and indeed may still be taking a hit when it comes to the service sector. Investment declining by 49%. That number jumps off of the page. And an interesting question, maybe Mike Santoli picks that up, is maybe you have this great big pent-up demand in investment, but business investment declining by declining by 49%, exports down 64%, imports down 53%. Bigger concern right now are those jobless claims numbers, which suggest that I don't know what you want to call it, the de-openings or the reclosings are having an impact. I didn't get to look at the total number, but what people need to know is that there's two different programs out there. One is for contractors and freelancers, and the one is the regular program. At least 30 million people are receiving some form of jobless benefit out there. The result of all of this is the crazy idea that personal income actually rose, and that's largely, I have to think, in part because of the massive government transfers. Personal income up 1.4 trillion on the quarter from the BEA number, and that's because so many folks have been receiving some form of government aid. I will get you that total number of claims that's out there, which is the two different programs together, Andrew.